Hello, this is Patrick Parlato. I wanted to continue our conversation and just jump right into the income statement. Similar to what we did with the balance sheet, I'm going to talk about both Pepsi and Chipotle, although I'll do them in one session because the income statement might be there are fewer line items, so we might be able to get through it a little bit more quickly. So let's jump right into it. Hopefully, you've been able to see and listen to the balance sheet stuff, and we'll cover the statement of cash flows. But right now, we're going to jump into the income statement. So I'm going to start here with Chipotle just to show their income statement here. They have total revenue. That's their line of revenue. Companies will say this differently. What does that represent? That's the all of the items they've sold to their customers during that period. Uh, in this case, the period would be each year. So the income statement is not at a moment in time like the balance sheet. It's for the 12 months ended. In this case, the comparative income statement gives 3 years as required, which is the year ending 2020, 2021, and 2022. We're not assessing their performance in this particular discussion, but you can see there's growth in revenue and changes to their expenses. So just digest that a little bit, but not in any way attempting to make a conversation around, improvements or weaknesses or anything like that. So after their revenue line, which is a little over $8 billion a year, they list out their core operating expenses. And I want to emphasize that because on this slide, one of the benefits of the income statement is it's actually built around giving us a lens into their core operations and then separating out from that the other expenses that a company incurs. And specifically, in their core operations, we have the revenue, of course, but then also the operating expenses, and then we'll have other expenses later. I did that in blue here. Nothing specifically amazing about the color choice I have, but I just wanted to intentionally intervene in the process to show some segregation within the income statement. So naturally, income statements are already designed to give us a difference between operating revenues and expenses and then the other expenses and items they have. In their operating expenses, they actually list this, which is not a requirement, just a unique thing to Chipotle, but some other restaurants do the same thing. We'll see that Pepsi does not do this, but they list their restaurant operating cost, exclusive of depreciation and amortization, which I'll mention in a second. So what are their restaurant operating costs? I actually like Chipotle for this reason. One of the reasons I chose them is I'm hoping you're familiar with them, but they list these out. This might be a little bit easier for us to work through. Food, beverage, and packaging, the actual cost of their ingredients, so of the food that they're giving us. But that's just like the raw ingredients, and that includes things like the aluminum foil and the paper bags they put the food in, as well as the burritos and the avocados that they use for guacamole and the corn and the salsas and all that other stuff, right? So all those specific items. Labor is the cost they're going to spend. These are restaurant operating costs of the amount that they spend on wages and salaries for the workers at each of their restaurants. Occupancy cost, that would be like the cost of rent in many ways, the cost of occupying that particular space. That they have. Other operating costs, that could be a host of things. We know these are related to their restaurants, but there'd be a host of other incremental expenses you have. This would be a great reason to look at the footnotes to figure out what's going on, to figure out like what are the other operating costs. After that, we have general and administrative. And here, I just want to be clear, the general and administrative would not be their restaurant level cost. That would be more of the broader corporate headquarters at Chipotle. General and administrative would be the cost incurred by the company, related to running the business, but not necessarily directly related to, in their case, operating a restaurant, selling burritos, and the other food they sell. They also separate out depreciation and amortization. That's not a requirement. I mean, unfortunately, the negative of that is it's depreciation and amortization of their stores. And so it is definitely a restaurant operating cost. In their defense, they're saying that it's exclusive of depreciation and amortization shown separately below. They're leading us to say, hey, we separated this out. They're not necessarily giving us the reason why they did that. But if we wanted to include it, which I would recommend, if you were doing actually looking at their profitability of each restaurant, you would want to include depreciation and amortization with the other restaurant level costs. Pre-opening costs. So when Chipotle opens up a store, they incur incremental expenses. And then when they close a store or have an impairment on a store and dispose of the assets associated with the store, they would have expenses there too. I want to note those two. First, they're not that big, which makes sense. They really shouldn't be. But they're still operating expenses. And the reason why they're operating expenses is that opening and closing stores is still a part of their core operations of running those stores and is relatively recurring. As you can see here, they have pre-opening costs and impairment of store closure costs in 3 of each of the 3 years that we see presented here. And actually, if you go back in time, it's pretty much the same across their past years as well. So if we add up those, we get the total operating expenses. Now, that's all of their operating expenses. What's their total revenue for the fiscal year ending 2022? $8.6 billion. What's their total operating expenses? $7.4 billion, giving us income from operations, which is also called operating income or operating profit, of $1.1 billion. So the blue part right there, that ends the discussion on their operating revenues and then operating expenses. Companies still have other expenses or other items that have to be included as well. So, for example, they have interest, which is likely interest expense and other income. Importantly, that's not just interest expense. The other income means that's different things there are netted together. So that's outside of their core operations. They could be making some income off their investments that we saw on the balance sheet. They could be incurring some interest expense on their debt. Then they have the subtotal called income before income taxes, and then the benefit or provision from income taxes. What that represents here is just a fancy way of saying income tax expense. So they had taxable income or income before income taxes of $1.1 billion, and they had tax expense of $282 million, giving them net income for the fiscal year ending December 31st, 2022 of $899 or almost $900 million. So that's their income statement. What's listed here, revenues and expenses, and then expenses. And I think this is really important. It's one of the excellent lenses we get from the income statement that we actually don't get on the other two statements, is that we get to see that direct focus on their core business, which I did in blue here. Companies don't use this color scheme. And then the other items, expenses, other income, et cetera, that come after that, resulting in net income. So revenue minus all expenses equals net income. But the organization of expenses of operating and then those outside of the core operations is a valuable lens we get from the income statement. Let's take that and just apply a similar conversation or continue our conversation with Pepsi. So Pepsi has, and this is actually an interesting point to make here, Pepsi gives a lot less total information. And you could actually look at in many years, their normal years, they wouldn't even have two of those items. So they would have net revenue always. They have cost of sales and then gross profit. So that's a subtotal. And then they have selling, general, administrative expenses. And that's really it for their operating stuff. So what is Pepsi doing here? Totally legal, totally allowed. They're actually doing significantly more aggregation of their operating expenses. Their operating expenses are roughly really just in two areas: cost of sales, which is a very broad term that can include a lot of things, and then selling, general, and administrative expenses, which is also a very broad term that can include many things. So then they have two other unique items in fiscal year ending December 31st, 2022. That is the gain associated with the juice transaction, and then the impairment of intangible assets excluding goodwill. So that kind of stuff happens, but and for the sake of net income, we're recording all gains, losses, even ones that don't recur every year. So net income is focused on being complete. So you do have situations where you have items that might be non-recurring or one time, and we'll do a deeper dive into assessing them later, but are still required to be a part of their as a part of their income statement. But I want to mention that because if you go back to like December 25th, 2021, let's assume that's more of a representative year, and those two items are zero, that really emphasizes how much aggregation Pepsi does on its income statement with its operating expenses, because they would only really be listing cost of sales and selling, general, administrative expenses along with net revenue. Gross profit is a subtotal, revenue minus cost of sales, and then operating profit is also a subtotal. It's revenue minus all of their operating expenses. So a lot less detail, line by line detail with respect to their operations. To be clear, they have all the same expenses. All the expenses are there. They're just highly aggregated. And one of my reasons for looking at Chipotle and Pepsi, other than hoping that you're familiar with them, is to show that Pepsi has a highly aggregated income statement. And just to jump back real quick, and Chipotle really doesn't. Chipotle lists out significantly more items. Now, we can certainly still get more detail about Pepsi if we read the footnotes, but on the face of the income statement alone, we're giving very few lines, meaning a lot less detail. It'd be hard with this alone to figure out like what was going, what expenses were increasing or decreasing in relation to revenue. That being said, let's jump down to the other half. They actually have slightly more stuff outside of the core operations. They have pension and retiree medical benefits income. That's separately reported. That's actually relatively rare. Some companies kind of still have legacy pensions, but most companies don't have them anymore. They have net interest expense and other. So again, not literally interest expense. That is not usually reported on income statements as its own item. It might be combined with other things, as we see there, we saw with Chipotle. If we put those together, we get the subtotal of income before income taxes, much like we saw with Chipotle. They have provision for income taxes, which is the fancy way of saying income tax expense. And that gives rise to their net income. Now, Pepsi has a unique arrangement where there are what are called non-controlling interest, that are a part of the income that Pepsi is generating, but not exactly the same as their own shareholders. So that's separated out to get net income attributed to PepsiCo, which can be interpreted as net income that's attributed to the shareholders of PepsiCo itself. A deeper dive on that last piece. It's not that uncommon. Not all companies have this as well, but still, with a different income statement, different business model, I want to just quickly recap what we see here with Pepsi. They have revenues, they have expenses, they have a lot less detail than Chipotle and other companies, but they still give us their operating profit, revenue minus all their operating expenses. They have a series of other items that come later in the gray section, and ultimately that results in their determination of net income. Net income being revenue minus all their expenses and other items to finish off our income statement. That's it. We still got statement of cash flows to work on. Hopefully this was useful. Take care. One more down, 10,000 to go.